constructed the forum with Tim Mueller as our lead speaker to present an insider's view on the dynamics at play within the IT services M&A market. As CEO of IT ExchangeNet, Tim is actively involved with both buyers and sellers within the space, and we are confident he will share unique aspects, unique insights based on his hands-on experience. Tim himself, and being very brief, his bio highlights are before you. But Tim has a very impressive list of successful entrepreneurial startups. These led him to his past selection as the Entrepreneur of the Year by a joint USA Today, NASDAQ, EY award. Tim, we are very glad to welcome you, and we will leave it to you to better introduce yourself and your firm. Thank you, Tim.
Rob and Amr, thank you very much, and it's good to be with you all and with this esteemed group of executives in the IT space. As a brief introduction, ITX, we've been around for a little bit more than 20 years. My business partner and I have completed over 175 transactions in this space. Our focus, particularly for this discussion, is the middle market space, doing transactions typically less than 35 million US in transaction value. So we really like working with the entrepreneurs in finding buyers that are in that kind of middle market and even upper middle market space who are looking to grow by acquisition. And so our role really is bringing buyers and sellers together. And we really only focusing on the IT services space. That includes managed services, cybersecurity, your typical IT services firm, and then really go deeply into the Microsoft, Oracle, and Salesforce ecosystems. So I think what we're talking about today is something that we do keep our finger on the pulse with, and happy to share what we've learned in this kind of pre-COVID and now COVID space and how it's affected M&A.
Great. Thanks, Tim. I'll maybe kick us off with a first question on private equity. There's close to $2 trillion in dry powder that still needs to be deployed. In your experience, Tim, what do private equity firms look for in the IT services space? And do the way, I guess, they approach valuation, does it differ from a strategic buyer?
Yeah, it's a great question. And I think we have to start off by saying that, according to PitchBook, we've seen that add-on acquisitions really account for 68% of all private equity buyouts in 2019. And we assume that that's going to be the same in 2020 and probably 2021. So first and foremost, as the private equity firms are looking to make acquisitions, we don't see them standing still ever. We see them take a platform business that they feel they could build around or layer business underneath them. And those platform companies typically are in that kind of $20 to $50 million range to begin with, and then being able to add on some additional $5, $10, $15 million firms to start getting into that larger $50 to $100 million range in revenue. So they look for businesses, particularly CEOs, that could be team players. They want to make sure that, after driving the bus for so long, they could be a very good and capable bus rider. In some cases, they're looking for the CEO to really take over the entire platform build. And so those are important areas on the talent side, but also on the service providing side. Some of the hottest areas that a lot of the private equity firms in our space are looking at are MSSPs, which are the managed security service providers. They're doing cybersecurity offerings. Your managed service providers, MSPs, that are also, in that space, but perhaps are doing more of the hands-on, bringing in technical folks and CTOs and to do a lot of the work inside. The big two most seductive words I think you'd see in most of these acquisitions are recurring revenue. Those two words really kind of drive a lot of what the private equity firms are looking to build off of for the obvious reasons. If you've got 70 to 90% recurring revenue and they're all tied into 1, 2, 3 year contracts, it mitigates a lot of the risk for the private equity firms that once they make the acquisition, they're not seeing now customers walking off and now the business is now devalued in the period of a year. And I think the other part that private equity firms are looking at very closely is, what are the entrepreneurs or the founders' goals? Are they looking to retire and hand over the keys? Well, that's a different play altogether because now you're parachuting the management team in or taking over. Or are they looking to really advance themselves in the family photo of that platform? So, younger CEOs, a lot of gas left in their tank, and they want to do something that they themselves can take advantage of the accretive value of the built-in company, that over 2, 3, 5 years, they're able to take a second bite at the apple and enjoy a much greater exit the second time around.
Thanks, Tim. I want to go a little bit further into the velocity of consolidation within the IT services. What do you see driving the pace? Do you see it as sustainable? You made reference to seductive and security, but perhaps what do you see as unseductive, but where there may be a contrarian's opportunity?
Yeah, so the velocity, we see that continuing well into 2021 and beyond. A big part of it is that the owners, the shareholders of these IT services companies are demanding more than just organic growth. So they're seeing that it's either you need to acquire or be acquired at this point. Just normal organic growth, year-on-year growth of 10, 15% doesn't do it any longer. And so these larger, and when I say larger in the mid-market, it could be a $75 million revenue company, it could be a $500 million company, or it could be some of the larger players like KPMG, Accenture, who we've seen, particularly during COVID, are swimming downstream and looking at assets that they would normally not have been seeking to acquire. But because of the lack of deals that are in that $200 million range at this period, and also, again, about risk mitigation, they acquire a smaller business. They're able to achieve their 2020 objectives or 2021 objectives for M&A. Number two, they mitigate their risk because it's not as big of an acquisition. Number three, they're able then to cross-pollinate or to sell into the customer base of the acquired business. So we see some of those larger players coming down into that mid and smaller mid-market space. In addition to that, the velocity continues because I think the decision-making on the founders is changing. We have a lot of, not hundreds, but thousands of businesses out there that are owned by baby boomers. And so purely by father time, they're starting to feel as though they want to unlock the value of the business. And we spoke with numerous owners that are in that kind of 60 to 70-year-old range that are going into 2020. They were very excited about selling, and then COVID hit. And I think it really jarred them that they didn't go to market and didn't try to unlock that value. So there is quite a bit of sellers out there that are helping that velocity continue. So when you've got the amount of private equity capital and even strategic money, and you've got the number of sellers that are looking to, exit from their business, it really becomes a very positive, perfect storm.
Great. Tim, in your intro, you touched briefly on COVID. Can you expand on how COVID has affected the mid-market space, specifically when it relates to M&A, private equity investments, valuation levels, and just general deal flow?
Yeah, first, like everybody else, March, April of 2020, we didn't know what to expect. None of us had gone through a worldwide pandemic before and how it affected M&A. But by the May, June timeframe, we saw that the businesses that were continuing to show that they could power through this, that not only their current monthly revenue, but also their projections of pipeline to get through 2020 were going to be strong. And that encouraged the buyers to say, you know what, we want to continue with this. The money didn't go away. It was just the decision-making started getting a little bit more, I think, pensive at first. But then by the time the summer hit, we saw deal flow just continuing like it did 2019, at least in our space, that smaller mid-market, whereas this will be a record year for us. We think that still a very strong year for acquisitions. Now, the other businesses that did get negatively affected by this, by the COVID pandemic, unfortunately, they were labeled as distressed businesses and businesses that were likely to get a discount if they continued on with the M&A process. So we've seen quite a few people hit the pause button and say, we're better than this, and we know that we can get a better valuation, and this is just a blip in our revenue pushback. So they'd rather wait until 2021, mid or whatever it might be, 21, to re-engage and go back out to the marketplace. And both strategies work, but for those who really did, survive and thrive, through 2020, were able to continue down with their valuations and have a good exit. As far as valuations and how it was being hit, one of the things that we had seen, and we've got 3 more deals that are going to close before the end of the year, is that valuations, big picture, let's call it transaction value that includes an earnout, any kind of tail that's involved in it, we have not seen that decrease. What we have seen is less money cash at close. So again, put yourself in the buyer's shoes. They want to try to mitigate their risk. They don't know what 2021 might be ahead. So instead of some of the normal 65 to 70% cash at close, maybe 80% cash at close, it's probably in the mid 60s up to 70%. And the rest then is tied to milestones over the next 18, 24, maybe even 36 months that are tied to the success of that integrated company into the acquired ecosystem.
Thanks, Tim. And perhaps going a little bit further into the practical realities of COVID-19, how have you seen people deal with the challenge of face-to-face? It used to be a big part of the due diligence process. Can you say how they've addressed this and whether you see face-to-face starting up again?
Yeah, purely by this virtual conference we're having today, I think there's been a tectonic shift, if you will, among people getting used to speaking through a lens and a screen and getting to know each other. We're witnessing that with many of our children that are going through the educational process online, all the way to how do you best keep a company's culture together, and a lot of it's online. And now in our space, the typical acquisition would be, have a couple of calls by phone, do a little bit of data exchange, and then a team of buyers would then fly into the seller city, have a nice dinner, spend a day together, and really look at each other in the eye across the table and get to know each other, so that they're not only the analytics work out, but what does the gut feel say about making an acquisition. And so most all of our acquisitions have taken place through the camera, instead of the flying. We saw probably in that late summer, early September, October range, people we're jumping on a plane and going to see the sellers in their home city. A lot easier, particularly if it's East Coast and they're able to take a car and make a 3 or 4, even 6 hour drive to go meet with the buyers and be COVID safe. But now with this new, I think, push, I think a lot more of the buyers have gotten a little bit more tentative about jumping on a plane now going into the holiday season. So I think just purely by the fact of trying to be safe, people have made it work, and they've used Zoom, Teams, or whatever it might be to get the work done, to get to know each other by video.
Okay, that's great. Maybe one final one for me. Looking ahead, when we're thinking about 2021, can you speak to the supply and demand for M&A deals in the mid-market space specifically? Then when thinking about the results of the presidential elections in the US, any impact there on IT services and the tech space in general?
Yeah, so going into 2021, we're bullish in this mid-market and small mid-market space that the supply and the demand will remain very high. You've got Mike from Quisitive is on the line among others that are going to speak today, and their whole mantra is let's continue to be strong in our organic growth, but it's very, very key in order to get acquisitions done in order to achieve their long-term objectives. So we still really believe, and the numbers are there to show that supply and demand. I'll harken back to my comment a few minutes ago, a lot of the baby boomer owners, but you also have a lot of people in their 40s who have looked in the mirror and said, hey, I've gotten it to 15 or 20 million, and I'm just not the person to get it to a higher revenue target. And the fact is, I really don't want to do HR, tax planning. I really don't want to figure out the operational side. I'm here to grow a business. And so to meld into a much larger ecosystem and allow them to unleash their talents and maybe leverage the marketing muscle of a bigger buyer and such allows them to really achieve their professional objectives. We see that continuing just as it was in 2018 and 2019. The one thing I will make a point about, your question about the presidential election is that, still to be determined on the 2 seats in Georgia, but it's clear that the Biden administration is seeking to make some tax changes. And one of those is capital gains tax that allowed up to this point sellers to enjoy a 20% capital gains on their sale of their business. And if that does go away, you may be adding another 15, 17 points to that, which, again, makes it a lot more difficult to take the bite on the tax to assume that type of change. So sellers are going to have to do the math and figure out whether or not, if those tax changes go into effect, if it's still worth selling at this point, or they ride it out and see what happens 4 years later or beyond. But the fact of the matter is, at least at this point, it's still going to take a lot to get the taxes changed. And at this point, it's still that 20% capital gains. Overall, we'll see how the markets respond to the Biden administration coming in and some of the other policies that they make, and whether or not that does change through the IT services side. But what is going for us is that this is still a very transitional stage for companies that are doing the transformation to a true digital business. And to do that, IT services is the key element of getting that done. And with that, we do see consolidation continuing.
Very good. Thank you, Tim. We thank you for giving us a flavor of your views, and we very much look forward to diving deeper at the end when we get to the broader panel. So thank you, and we will be following up. With that, we are very excited to introduce Mike Reinhardt, the CEO of Quisitive. Mike, welcome, and over to you. Thank you.
Fantastic. Thanks, Rob. Appreciate the opportunity. I see a lot of familiar names on the attendees list, and certainly appreciate you guys joining us. What I want to do is just walk through kind of a quick overview. Many of you know the story, but we'll give you a little bit update on our strategy, talk about M&A, both in terms of how we accretively grow, but also our organic motion that we think complements that in an important way. So we'll kind of move forward here on the slides. I think I've gotten control. Doesn't look like it. Pooja, go ahead and advance to the 3rd slide, please. Thank you. So kind of our macro level mission is really driven around this idea of what I call becoming the Microsoft partner of the future. Many of you know that Microsoft has always leveraged a key channel relationship with partners to activate their technologies in the enterprise. And we'll talk a little bit about that, and really have built this model. I've been working in partnership in the IT services space and with Microsoft over the last 25 years, and have really built out kind of a unique position with them, but really twofold about how we're going to market under this mission of the partner of the future. One is really building this scale partner with and through Microsoft, centered around helping organizations move, operate, and innovate, leveraging the cloud, both on an organic growth basis and some of the things I'll talk about there, but also then obviously bringing together these highly fragmented partners across the footprint. But in addition to that is really complementing that with a set of software services where we build our own IP and bring that to market as part of how we build and grow our business. So we'll touch on that relationship a little bit. And really, when you think about, some people ask why Microsoft and why do they need it? Again, Microsoft is the premier player in the enterprise across a diverse group of capabilities, where they have not only the Azure footprint that we all hear and talk about around infrastructure as a service, platform as a service, and the things that they do there, but they also have these really other powerful cloud elements that they're the leader in around what they call Microsoft 365, which is also all the things around collaboration and messaging and Teams and the kinds of things that you're hearing about. But then also what I call finished goods, which are their SaaS offerings around Dynamics, ERP, and CRM. And that full breadth, and how in the enterprise space, it really creates I think, a huge differentiation. So really, our partnership with them is centered around, we're 100% committed to their platform and helping them win in the battle against the other cloud providers, and really gives us a unique position with them, access to training and other kinds of things that just wouldn't be available to other organizations. The other thing is we're highly recognized. It's always great. We're all very biased and think we're fantastic firms, but it's great to get recognized on the channel. Microsoft selected us as their 2019 United States Country Partner of the Year, which is the highest award that they give. The other thing, though, that's changing about how they partner in the universe, and we're seeing other major tech providers do this. They've always had these different establishing partnerships by having gold and bronze and platinum and whatever credentials. What Microsoft is really doing, something that's changing this fundamentally, and I think you'll see this across these different organizations, is actually moving. That's more of a marketing message thing that didn't have a lot of substance. I'll be honest, in the past, it was pretty easy to clear that hurdle, get a couple of marketing reference stories, and you're out there. But Microsoft is really changing that and creating this really rich audit service that they bring in and really go in depth to understand your process, your methodology. And we are one of very few that are securing these unique specializations across a broad dimension. And again, it's just taking and demonstrating depth and breadth around the technologies and activating that with them at their customer. So as we think about our business model, I'll just touch on this real quick. There's really kind of this set of services as we help organizations in their journey to the cloud. And really, there's a set of project services that are all about, understanding the journey to the cloud, building out and looking at what their migration strategy might look like, which things should move to the cloud, which shouldn't. We set a full complement of those services. Microsoft brings us in. They've introduced us to over 200 enterprise customers over the last 24 months because we're their agent to go in and help the customer understand why choose the Microsoft cloud, and then help them along that journey. Along the way, we start to bring these recurring revenues that Tim referenced, is really around starting to introduce different recurring revenue streams into the model. One is around the reseller of the Microsoft licensing platform. Those are all on 3-year subscription models. We get 15 to 30% margin on those as a representative, but then complementing that with managed services that are really focused around the high value services of managing and operationalizing the business in the cloud. But then most importantly, we have this really unique capability that I think is the long tail in the cloud journey, which is all centered around these rich, what I call solution services, really understanding how to productize and take capabilities to the market. We announced recently that we're partnering with Grant Thornton for them to re-engineer and reimagine how audit services are done through SOC compliance and other things. We do have all the expertise and build all that product for them, help them deploy that to their customer, run it in their Azure tenant. We're the licensing arm providing managed services. And is really a big differentiator, is having that really rich understanding of how to apply these cool new technologies to bring value to customers. So our M&A strategy is really focused around these target profile, and Tim referenced this, is companies 10 to 50 million in revenues. They're growing businesses that typically 10 to 12% EBITDA contributions, have some level of recurring revenues. Sometimes that's through an IP that they may have created, could be through licensing managed services, looking to create scale and reach and do some of those things. We've had really good success doing that, and I'll touch on a couple of those. But there are lots of these kinds of businesses out there. To Tim's point, though, earlier, there's kind of the haves and have-nots right now. Some have weathered the storm well, and certainly good discussions going. Others, they did struggle through the pandemic, especially at that size. If they happen to have a customer of size that was in one of the distressed industries, whether it was hospitality or others, it could have had a pretty big impact to them, but a short-term one. And we see a lot of those firms coming back into play in the next year. Our deal structure is, typically this model of where we're leveraging cash that we raised through the capital markets, certainly using equity as a currency. And then to Tim's point, we've always had this mindset of earnouts being a key component of transitioning the business successfully. We actually look for owners that are going to be embedded in helping us build and scale this, not looking for somebody who's looking to exit. We're not in that buying model where somebody wants to get out in 12 months or something. That's just not the right fit for us. So we're really targeting those guys, to Tim's point, that was about, they've got a lot of gas left in the tank. They've built an interesting business. And what they actually want to do is be part of really scaling something out. Those sellers fit our model and like what we're doing, because I'm one of them. I grew up in a garage, with two guys building it from nothing, scaling it out and growing it. We have this unique relationship with Microsoft that allows them to be part of a wave that is created with and through them to activate organic growth that they may not be able to create on their own, and bring that together as part of a combined business value. One of the other things I think that's important about our M&A strategy is about what I call unlocking our potential. A lot of people in an M&A model talk about back office integration and cost synergies and those things. And we certainly, look for those opportunities. But the real opportunity in my mind is actually bringing all that together at the point of the customer and creating that value. So we have a whole mantra around one Quisitive and the power of one, and really creating a rich integration strategy that combines our brand integration, where we'll all operate under a Quisitive single brand and transitioning over to it, back office systems and the things we talked about, but also team and process and methodology. One of the biggest things as I embarked upon this strategy, I interviewed lots of people at Microsoft, lots of CIOs and customers. And one of the things they said was their biggest frustration is having to work with 4 or 5 different partners to enable their digital transformation journey. What they really want is the proverbial one throat to choke. And really in that model is thinking about, how do they go to us as a single enterprise with rich capabilities on a broad spectrum and serve their needs on many dimensions. They don't want to work with me and have 4 different companies with 4 different approaches and 4 different contract types and all those things. So we bring all of that together and have made great progress in doing so. And we believe are able to increase wallet share per customer as a result of that. A couple of the acquisitions we've completed over the last, I guess, a little over 15 months now. We did an acquisition out of Ottawa, Canada, Corporate Renaissance Group last June. Really helped complement a component of our business around 3 cloud capabilities inside of Microsoft, especially around the Dynamics platform, which is their area of specialization. They also had some really interesting recurring revenue streams, not only on licensing subscriptions, but a first-party platform called mPerform. That's an employee performance management platform with over 100,000 users that really helped us kind of blend that and diversify it. It was a 30% EBITDA business that we were able to acquire on about a 6 times revenue model, or 6 times EBITDA model, apologize. The second one we completed was earlier this year in Menlo Technologies. Really helped us scale our global reach, about a $17.5 million business that really gave us access to both East Coast and West Coast in the US, where they had offices in both Silicon Valley and Washington, DC, as well as a strong offshore development arm in Hyderabad, as well as a growing footprint in South America to give us the nearshore, offshore combination along with our footprint here in the US. So, real quick snapshot, give you the timeline. We're roughly a $50 million business as we sit here today, with about 20% of our revenues recurring and continuing to grow, about a 16% EBITDA business. We've got 8 North American locations, have completed those acquisitions, did some financing this summer that Echelon was a part of with us, and did some things to do some balance sheet cleanup and things as we move forward, and looking to really see 2021 as a strong M&A. We had a lot going on. We also have a product called LedgerPay that we're launching, which is a unique element that we're building out a full payment processing and payments intelligence platform. I won't spend too much time here talking about that, given the focus of this discussion, but that's an optionality that's built in to our business that, again, as we work with these customers, we see these business patterns and the opportunity to invest in software IP that we think can bring unique value to a broader market set and to shareholders. So kind of why we're market differentiated. We have a rich history working with Microsoft, one of few that meets with Satya Nadella and Kate Johnson, the president of the US, and others globally, and get access through programmatic funding and other kinds of things that is quite unique. Obviously, we're continuing to grow our recurring revenue streams through the various channels I talked about, including our first-party products like mPerform and LedgerPay as we bring that together. And then again, sort of this combination of the momentum of the motion that we create with and through Microsoft and this unique relationship that we bring to the sellers of these businesses that allow them to activate, scale, and grow in ways that they wouldn't be able to do on their own or have access to. Quick cap structure for those that want to get a peek into where we sit today. About $180 million market cap, as I talked about, on roughly a $50 million revenue business at 16% EBITDA. That's what I had prepared for the discussion today. I'll hand it back over to the team at Echelon and go from there. Thank you.
Great. Thanks, Mike. That was very insightful. We're now excited to introduce Paul Raymond, the CEO of Alithya. Paul, our thanks to you and welcome, and I'll pass it on.
Thanks, Amr. All right, well, good afternoon, everybody. Very happy to be here with you today to talk about Alithya. So Alithya today, we're over 2,200 people, Canada, US, Europe. Our revenues are about 50-50 Canada and outside of Canada, a bit more in Canada today. We really specialize in designing digital transformation solutions for customers. So we help them build a solution, we implement the solution, and we accompany them after the solution's been implemented. So our vision is very simple. We want to be seen as a trusted advisor, which means we need to be experts in the customer's business and also in the technology solutions that they need to implement in their businesses. We're very value-driven in terms of our people, our employee-based, our full-time employees. We have many different programs to make sure we attract and retain the best people in the business, and I'll talk about that a bit more. So, as soon as the page changes, there you go. So today, to give you more specifics, our services are divided into 4 buckets. The largest of which are enterprise solutions. These are all cloud-based enterprise solutions, and you can think about ERP, HCM, CRM, everything that a business needs to operate, basically from a back office perspective, running their inventory, running the business. It's the largest part. It's more than 50% of our revenues, all cloud-based. And again, this is really the application side that we work on. The other larger part of our business is really the custom approach to that, where a lot of customers have legacy applications that they want to move to the cloud, not too sure how to do it, but they do want to keep the functionality of the applications that they have today. So we do a lot of transformation type projects where we move stuff from legacy environments to cloud environments. Some of that is what we call lift and shift, but most of it is really transforming and adapting the applications to the cloud. Whereas lift and shift is more of an environmental issue, we look more on the application side. The 2 other parts of our business, one is upstream and one is more downstream. The upstream part is really the business strategy. So we actually do consulting on the business side to help our customers decide on what they want to do in terms of a solution. So how they're going to migrate to the cloud, what their strategy should be, how to manage the change that comes with that, which is significant for larger organizations. And finally, the last piece is really a horizontal that we apply to all of our projects around data management, business intelligence, AI type, IoT integration, which is also a very rapidly growing part of our business, but also essential, especially in digital transformation projects. We're also very fortunate, given what we just went through as a pandemic, whether by choice, by design, a bit of both. All of the sectors we are involved in are part of essential services. So in the first 2 quarters during COVID, our fiscal year starts April 1st, we've actually seen some growth in the company year over year in those 6 months of the pandemic, the first 6 months of the pandemic, because our customers are growing and they have to live through the pandemic, and we've had to support them. And the cloud projects are accelerating at many of these customers as well. So we believe we have the right sectors to focus on. From a technology perspective, interesting follow-up to Tim and Mike's presentation. Given our vision is to be a trusted advisor for our customers, we believe we need to be able to accompany them in more than one technology. So today, if you look at it from an enterprise business perspective, we are in the inner circle at Microsoft, so which means that in Microsoft, we are the top integrators on the ERP and CRM side in certain verticals, in this case, manufacturing. So we are in the top 1% at Microsoft, the inner circle that they call. We've won many prizes as being one of their top providers. And again, this is for the business application side. Same thing on the Oracle front. And again, this is Microsoft Cloud and Oracle Cloud we're talking about. We are also in the top 1% of Oracle in certain very specific sectors, and that's how we differentiate. So for example, we're the #1 in healthcare today for Oracle ERP and HCM in the US. Finally, we know that many of our customers looking to migrate to the cloud need help. Given our scale today, as I was mentioning, with the 2,300 people, it gives us a lot of leverage with some of these key providers who are now coming to us to be able to be a partner to them. Given our presence in Canada and our growing presence in the US, it gives us a great negotiating power with many of these providers who want us as a partner. We want them, they also want us. So it's very useful in negotiating these agreements and working with our customers when we can bring these partners to the table. And when you're a key partner of these organizations, as Mike was saying, it comes with all kinds of benefits, whether it's training benefits, marketing credits, joint marketing efforts, and so on and so forth. So we've been able to leverage that, and our scale has enabled us to do it even more. We were very transparent when we went public, just 2 years ago, November, with our 3 to 5 year plan. And one of the reasons we went public was to be able to execute this plan. And we talked about organic growth of higher value business and acquisitions that I'm going to talk about in a second. We also talked about how we're going to foster a culture of ownership and attract and retain people. We know that the biggest challenge in our industry is attracting and retaining talent, especially in a business like ours, where we're more in the higher value type services. We're not a staffing company. Therefore, our people come work for us because of the cool projects. We have to be able to hang on to them and retain them. So we've put many programs in place. One is our Leadership Academy. Every stats that you looked at, people leave their leaders before they leave the company. So we believe that if we have the best leaders, we're going to attract and retain the best people. We work very hard at that. We put a share purchase plan in place for our employees to foster the ownership mentality. And we've done a lot around employee well-being and taking care of employees. As an example, 100% of our people work from home since before the government asked us to do so. So back in March, before everything kind of fell apart, our people have been set and working from home, and we're implementing ERP solutions remotely for customers, and it's been working very well. Finally, on the investor side, we've also said that we want to make sure that this long-term growth that we're doing is going to be profitable growth. So we're very disciplined in our acquisitions and the type of work that we go after. And of course, we are trying to do this in a responsible way. So if you look at kind of track record of acquisitions since going public in 2018, and I could talk about the ones before, but I specifically like to address the last three that we've done, which are very recent. I'll start with Mattresses, which was an IoT type organization. So we saw an opportunity because of the sectors that we're in. We saw a huge demand from our customers into integrating more of their on-floor type systems, the operational systems, into the back office and the ERP front. So this was a very useful acquisition for us. And again, we've been able to generate growth in that business since they've joined us. The next one we did was Traversant, which was a Dallas-based Oracle Cloud ERP delivery experts in healthcare. And again, a great example of the leverage that we get from these acquisitions is that on their own, they were very good. They were seen as number one, but because of their size and scale, they couldn't go after the bigger projects, or if they did, they had to subcontract to somebody else. Now, instead of being a 50-person organization, they come to the customer as a 2,200-person organization. And because of that, we've been able to win some very large projects in healthcare, which we could not have won alone, and they could not have won alone. We actually announced those deals a few months ago. One was with Nemours. Some others were with some very large Canadian cities on the municipal side. Esquita was the last acquisition that we've done that specialized in QA and automated testing. So this actually brought us some IP, which we did not have before, which we can use to expand the services that we do within our customers. So most of our customers are very large organizations, blue chip type organizations. We do very little work with small organizations. So what we see as the biggest value, coming back to our vision as being a trusted advisor, is the relationship that we've been able to create with our customers. Once we have that relationship, we work with the customer to figure out what else can we bring to the table. Testing was one of the things that was identified by our customers as something that they not only needed, but is essential to every transformation project. We've also used this internally on ourselves as we've implemented our own cloud ERP solution internally to be able to support our growth and integrating these new acquisitions. Give you an idea, anybody who's done an ERP cloud implementation, beauty of cloud is you're always up to date. Challenge of cloud is you need to be up to date. So every quarter, our customers get push updates from these providers, whether it's Oracle or Microsoft and so on. They have to retest every time. This puts a big burden on the operational teams and the organizations to retest these upgrades every time they come. We've been able to automate that. So we've done it for ourselves internally now. That's something that we're reselling to our customers because of what we got with these acquisitions. So we really look for the acquisitions that not only are we going to help them grow, but we believe that together we could grow a lot faster. I'm just going to leave on one financial slide. This is our growth rate has been significant over the past few years. We've seen a slowdown in COVID, even though we did have some growth in COVID. Coming back to our EBITDA of the last 6 months, so the first 2 quarters during COVID. And we've commented on this publicly, so this is not new information. But I just like to leave on that. Coming back to the third bullet that I was talking about earlier in our strategic plan. When COVID started, we were very clear with our people, with the street, that we saw 3 very important priorities during the crisis. One was to protect our customers, protect our people, and protect the company. We saw a slowdown in some of the project startups, which, if it were a normal situation, given we have very flexible workforce, you can adjust up and down very easily in terms of how many people you need for projects. We typically have a pretty long lead time. We can adjust up or down in normal fashion. So during COVID, we cut every expense that was deemed non-essential. And one thing that we deemed essential was hanging on to our consultants for projects that we knew were just being delayed. So we know that had an impact on our EBITDA and a bit on our gross margins because we had more people available not billing for a period. We're very happy we made that decision. I think the value of what a company like ours has to provide to our customers is directly tied to our workforce. So we invested some money in the last quarter to make sure we hung on to our top performers and our best people. And we're very confident that's going to pay off in the medium and long term for us. That's it in a nutshell. Amr, Rob, on to the next one.
Thank you, Paul, and great leading on such a positive note. So with that, we are very excited to introduce Sean Main, the CEO of Converge. Sean, welcome, and over to you, please.
Thank you. And hopefully I can also move this down a couple slides here. There we go. Okay, so just to give an overview of Converge, Converge didn't exist in September of 2017. I had no revenue, no management team, no certifications. From a standing start, we bought 13 companies over the last 3 years, have a run rate around $1 billion revenue. Our trailing 12 EBITDA is 49, and if you add the cost out, it's like 64 million of adjusted EBITDA. We had a really busy time this year, especially the second half of the year. We are the fastest growing IT service provider in North America due to both organic growth and through acquisition. As you see, our adjusted EBITDA grew 150% year on year. Our revenue increased 31% year on year. We've done an acquisition, so 2 acquisitions so far this year. We buy 4 to 6 companies a year, so therefore there's a bunch of coming in December as well. We also integrated all the back offices of our US subsidiaries so far this year, even during COVID, taking 20 million of annualized cost out, or 5 million a quarter. We changed our ABL to be much more efficient. We don't use equity traditionally in our acquisitions. We just use debt and working capital, and we pay between 4 and 5 times to buy resellers and turn them into cloud service providers. We also have done a little south of 110 million of straight equity financing through 3 financings since August. We raised 20 million at about $1.62. At the end of September, 35.4 million, and then last week we closed 46 million at $3 a share. We've just been approved to go to the TSX big board. Like the other 2 companies, Quisitive and Alithya, we went public about 2 years ago. So this plan I created in April of 2017, and the team's done a wonderful job of executing against it. If people who've seen my presentation before, this slide has never changed in the 2 years I've been presenting to the public. The first phase of our acquisition strategy was to buy a broad brush geographical coverage in Canada and the US and get top tier certifications with all my vendors to get things like better pricing, better rebates. In phase 2, build out all my capabilities around hybrid IT, advanced analytics, cybersecurity, DevOps, and managed services. And then in phase 3, integrate the back offices and scale. So really proud of this map. Our goal is to hit every NFL city because that's where our customers are. And during the pandemic, having this kind of geographical dispersion has been really good. Like I keep saying, looking at our financials, you can't tell there's a pandemic going on, but it doesn't mean we haven't been impacted. So in Q1, it was California. In Q2, it was New York. In Q3, the Southeast. But overall, having mid-market customers, mid-market being 1 to 10,000 seats, with this kind of geographical dispersion in the same kind of sectors that Paul was just talking about from Alithya, has really helped us that when you look at our performance, you couldn't tell there's a pandemic going on. So we're the fastest growing IT service provider in North America. We're also the 50th largest, which means there's a very fragmented space. We've also received a lot of awards, like here's some of the other ones. We really focus on Red Hat and VMware. We believe in a multi-cloud environment as opposed to just one cloud provider, and therefore those are our most important partners because of their Kubernetes implementation. So with Red Hat, we're their Rising Star of the Year. We won the IBM Analytics Partner of the Year and the Ingram Cloud Partner of the Year. So here's the 13 acquisitions we've done in 3 years. And as you've heard, doing one acquisition is hard. Doing 13 in doing these, and we picked them, and I'll go through how we chose them in this order, is really difficult. We've got a really experienced management team that knows what they're doing. So when we buy companies, the first thing we don't compromise is on culture. So that, is the start. The second one is customer. So the reason we've been buying these companies is to make sure that they've got those right sectors, those mid-market customers that need help getting to the cloud. The third one is geography. As I mentioned, we're looking for this wide dispersion. And the fourth one is capabilities. And in phase 2, capabilities is more important. So there's a list from CRN called the IT service providers. And we went through the 175 companies between 75 and 200 million back in 17. And we talked to 84, and these are the 13 we've bought so far. But we have a very busy pipeline. We went and did a pause during COVID, and now we're very much actively back on the acquisition trail and working through that pipeline, which, again, as I mentioned, you'll hear several more still here in Q4. So again, the capabilities that make you a hybrid IT provider and the things that really differentiate us in the mid-market are we have PhD data scientists. And these are skills around our analytics group on top of things like IBM's Watson and Snowflake that you don't see in the mid-market. The CGIs, Alithya's, Accentures will probably provide that into the large enterprise, but into the mid-market, you don't tend to see those, as well as world-class cybersecurity experts. When you move workloads to the cloud, you better have world-class cybersecurity people, as well as your DevOps people who are moving things inside of containers. So that's OpenShift from Red Hat or Pivotal from VMware. And then managed services. Our biggest growth and our biggest growth driver for organic growth is our managed services growth. And these are us hosting applications on behalf of our customers. And during COVID especially, you've seen a lot of growth of things like VMware's Cloud on AWS offering, which lets you access your applications remotely. So again, I completely agree with Paul. Sectors is so important when you look at where people are and during COVID, how have you responded? So 21% of our customers are from financial services, 19% from technology, 19% from government and state, local, and education, 16% from healthcare, and 7% from manufacturing. And of the other 18%, no one customer makes up more than 4%. So we're not exposed to oil and gas, luxury retail, hospitality, and travel, which have been so impacted during the pandemic. And again, we focus in on the mid-market, which is a $650 billion annual spend, US dollars. So we're less than, if you add that to the upper end of the 400 billion SMB, we're less than 1% at our billion of run rate revenue. We don't focus on the large enterprise, and that's really where a lot of people focus on. We've got a unique sales model. There's a misnomer that you can't make money in the mid-market, and we've got a very unique way of selling into there that's been very profitable for us. Again, as you heard, Tim open off with, the most valuable part of our revenue is recurring revenue. And of that, we have 241 million of gross annual recurring revenue, which grew 93% last year, made up of 3 components. 61% of that is our own managed services, hosting applications on behalf of our customers. We make around 40% gross profit on that. And those are 3-year deals paid monthly. Around 50 million of that is cloud pass-through revenue from Amazon, Google, and Microsoft. We view that Microsoft is the right partner for front office applications, your email, your ERP system. We view that Amazon and Google are probably better for your back office applications. So hence, we believe in this multi-cloud world, which if you put your applications inside of things from VMware and Microsoft called Kubernetes, that you don't have to be cloud native, that you can move your applications back and forth. And then the other piece is around 24% of our revenue is software sales. And then you have an annual recurring revenue piece for patches and upgrades for that piece. And again, I'm so proud of these slides showing our financial performance. Again, from a standing start to go from 52 million in Q4 of 17 to 190 million last quarter, which is our weakest quarter. Q4 is by far our strongest quarter. To look at, the gross profit growth that you see. And really that's how, because we buy resellers that sell are more kind of hardware focused into cloud services, gross profit growth is kind of our key metric. Our gross profit last quarter is kind of 7.6%, which really compares favorably to the kind of cloud service providers like Alithya provides. Our adjusted EBITDA growth, again, I couldn't be prouder of this growth. When you look at, in just 12 quarters to reach our trailing 12 is 49. And again, with the 20 million of cost out that we've just done, shown in our SG&A of our Q3 numbers, that puts us on a 64 million kind of annualized EBITDA number. And to achieve that through organic growth and through acquisition, I've never heard of a company doing this before. So after adding 110 million of equity since August, we have a very strong balance sheet. Again, we don't require equity to buy companies in the way that we buy them. To now using a lot of debt, we had a highly leveraged balance sheet that we were comfortable with. But now when you take all that equity there, it makes a big difference. Also, when you start off, you need a very flexible lender. So our asset-backed lending facility was with a specialty lender who cost us 9%, very expensive. We recently just renegotiated that with CIBC, supported by Scotia and Laurentian at 2.5% to 3%, $140 million line. So really reducing our cost of capital. We were paying over $5 million a quarter in interest. And when you take out the $5 million a quarter of SG&A and take out kind of $9 to $10 million a year in interest, we really generate a lot of cash flow next year. I couldn't say enough about the team. So when you talk about your acquisition strategy, people talk about, well, I'm looking for the leadership team of the acquisition targets. I don't. I look for great salespeople and great engineers, great sales and engineering managers, but this is the team running the company. And this is the team during COVID. Corey Reed, our COO, who I've worked with since Delaware Research in 1992, integrating 10 back offices and taking 20 million of cost out. Or Don Cuthbertson, who sets our technical direction and runs Canada, who, for them to perform like this, and Gord McMillan, who gets all our acquisitions structured and executed, or Carl Smith on the public company side, Greg Berard, who came out of our Lighthouse acquisition, who's our president, who runs all sales, marketing, and engineering, and structuring how you structure your management teams around acquisitions, really important. And Greg with that pre-sales model. Carrie Hash and Tommy Watley, who came from my last consolidation, then to new people, and a strong HR leader like Rhonda Haynes to deal with all the COVID restrictions, keeping our people safe and adjusting to those. Extremely proud of all we've accomplished this year, and still acquiring. So 2 companies we acquired. There's a bunch more coming, as well as cross-selling, renegotiating our ABL, raising capital. The team's done a great job this year. So I guess, Rob, that's kind of a highlight of Converge, and happy to answer any questions you have as well.
Awesome. Thank you, Sean. Really appreciate your comments and your perspectives. With this, we are very pleased to pull together our panelists for what we are confident will be a very engaging Q&A session. Amr and I will start off with a few questions, and then we will open it up for anyone on the call to ask questions, where you can use the chat function or submit questions via email to Amr or myself.
Maybe it's a question for everybody, mostly the CEOs, but I'd like to first ask about near-term headwinds and or tailwinds. Do you guys foresee significant impact with customers or suppliers with a growing list of geographies entering new lockdowns? Or has the ecosystem in general adjusted to that? Then in terms of tailwinds, do you see any unspent budgets in 2020 helping out 2021 demand? Maybe we could sort of stick to the same order, Quisitive, then Alithya, then Converge.
Sure. Well, yeah. So certainly the headwinds happened back. I think others commented on it in the early stages, but the space we're operating in and the technology enablers of these enterprises we're working with, they adapted fairly quickly. And many times we were the agent to help them adapt. So the headwinds seem to have been removed, set aside some of the segments that might be impacted. But as you start to think about, kind of the tailwind, we saw significant increase in certain areas where people accelerated their vision of digital transformation. 9 to 12 months ago, we were talking to them about this journey, what they needed to do over the next 3 to 5, 7 years, them having to go to boards and having difficulty getting clarity about budgeting and authorization. And all of that has accelerated, and people are looking at how do I, not just during the pandemic, but how do I continue as they see this as an ongoing thing over the next year. So from our side, we see increased activity and expect that to continue well into 2021.
Yeah, I'd add to that. I think the biggest challenge, I agree with Tailwind, we're seeing revenue growth year over year during COVID, which I think 6 months ago, a lot of people were wondering whether that was even possible. And I know that some of the larger players are struggling with that, but we're seeing an acceleration in these digital transformation projects. I think the customers have realized that working remotely, which before we, in certain circumstances, we had to have people on site, the customer, and that was one of our differentiators. We had local people on site in all of these locations where we had customers who could go in, hold their hand and implement these ERP systems. Now it's all being done remotely. And I think it's a genie out of the lamp type of event where we're going to be able to do a lot more of these, gives us a lot more flexibility going forward. I think the biggest challenge for everybody going forward is going to be finding people. I think as people realize that the digital transformation is accelerating, competition is going to grow to find people, because now we're not restricted by geography in terms of where we locate our people. They can be working from anywhere for anybody, as long as they're within our framework of how we manage these projects. So I think there's a tremendous opportunity there going forward.
So during the pandemic, the real driver we saw was the problems around cybersecurity attacks, because people were trying to access applications from home that bypassed the standard security and networks, which is done through Microsoft Exchange. So we saw a prioritization of finance applications that there was a 14,000% increase in cybersecurity attacks. So they were, if you look at the roadmap, the finance applications were probably last in their migration plan. All of a sudden they became first. And so there was a real driver there. The other thing we're seeing now is projects that were pushed off till next year in Q2 and Q3. We're now seeing, due to the announcement of the vaccine, projects that they needed the projects done are now being brought back into Q4 2020. So we have a very wide brush of customers and segments and geographies, and that's a trend that we're seeing across predominantly the U.S. Is projects being pushed ahead into 2020 that previously in the year have been pushed back to 2021.
Perhaps reversing the order. When you look at targets for acquisitions, can you talk to your strategies for synergies, be that on the revenue side, the OpEx side, or the vendor side, and how do you capture and what do you pay for those synergies?
So I'll start off here. So for us, we do something probably very different than the other guys do. I'm not looking for people with capabilities. I'm looking for people with great customer relationships that I can cross-sell. So I pay a lot less for them. So Mike pays 6 to 10 times for his. I pay 4 to 5 times for mine. And I'm buying a reseller with great customer relationships that my practice area will cross-sell. I bought Unique Digital October the 1st. We're cross-selling VMware's managed services, Cisco products, as well as our Red Hat Ansible products into that customer base. These are things that they couldn't offer before, that right away in one quarter we're cross-selling. So it's our practice area structure that allows us not to make the people that we're sell these, they identify the opportunity and bring in those opportunities. The other one, by getting top tier certification, is we make 1.5% of revenue and volume rebates from our vendors. So that's it. We buy them at 3% EBITDA, get them up to 4.5% through volume rebates, and then take cost out of 1% from the front office, 1% from the back office to get them to 6.5 EBITDA margins. So that's really our model of accreting. Start with the cross sell, get the volume rebates from the vendors, and then take the cost out.
Great. Our model's different, closer to Mike's. We look for businesses where the leaders want to stick around. So we're looking for businesses that have very high margin. So we spend less time on integrating finding the cost synergies and more time on the growth synergies. Typically, the businesses we go after have an EBITDA above 15%, sometimes significantly higher. And we look at ways to cross-sell and upsell with the existing customers. And the example I gave of Traverse earlier is a great example. Typically a large project for them was a couple $1 million. After merging with us, being able to go after larger organizations like the Nemours Hospital, where we're talking $8-9 million type projects. So it's a factor of 4 to 5 times larger projects we can go after. So much better margins. And we actually invested significantly in our back office. So all of our back office applications are cloud-based ERP systems, the same one we sell to our customers. So we can integrate these companies from a back office perspective pretty fast, but that's not where the savings are. We get the accretion really comes from the cross-selling and the accelerated growth of these targets.
Yeah, similar to what Paul's describing. I mean, the companies we're looking at are north of 40% gross profit type businesses. We're looking for high value businesses with high EBITDA contributions. Thus, the premiums that are paid both for these businesses. The public comparables in this space are many of them trading at north of 20 times EBITDA for companies that do these kinds of things. So it's a very different kind of value proposition. But it's all about, certainly there's still geographic scale and reach that I think, while we're all kind of shifted from one extreme to the other in the moment in the pandemic, I do believe there will be a component of that returns where you need to have regional distribution, both selling and execution. And as we're doing our M&A, we're not changing that strategy right now. We believe that that's going to be a really important component. So we're still buying for geographic reach while also getting technical depth and expertise. Back to the acquisition thing, there's a limited supply of people that can do these digital transformation capabilities and the expertise necessary to do it well. A high percentage of the work we do is actually going in behind other companies that started out with a customer and failed. And Microsoft says, come bail us out, because the firms that are doing this don't have the depth and expertise to do it well. So anyways, that geographic reach and doing some of those things, we're looking for talent to take to existing customers, as well as back to Sean's point is, take and go cross-sell these full set of services into the existing customers of each of those companies.
Great. I see we've got a few questions from the attendees. Maybe we'll do another couple of questions, and we'll start answering the attendee questions. So please keep them coming. Guys, so we spoke to this with Tim earlier, but looking to get your perspective as well. In terms of how COVID changed the M&A landscape, in terms of sellers' expectations, then are you guys seeing any changes in valuation structure in the markets? Then if you could touch on the face-to-face meetings as well, you guys as CEOs, how critical do you feel this is, and are you managing to execute on deals despite the lack of face-to-face? Maybe we could go back to the original, Quisitive, Alithya, then Converge.
Sure.
And Tim, obviously, please feel free to jump in where you have any thoughts.
Yeah, we all touched on this. There's really kind of two categories of potential sellers out there. Those that have gotten a little bit distressed by this, and those that have actually performed well. Those that are performing well, multiples have gone up. Valuations and multiple expectations have gone up. And to Tim's other point, the bigger strategics coming downstream into that market actually drive valuations up, because their ability to capture these firms is purely by price point. And so they're paying much higher premiums. And of course, that does all the things to set expectations. So we are seeing valuations come up. On the same token, as you think about how to do M&A, certainly we all live in this remote world and have, to be honest, 70% of our work was done through remote, using Teams and using other kinds of things to facilitate. So the transition wasn't big for us. So we already all know how to do that and very comfortable with it. I'm a big believer, though, I won't buy a company that I don't break bread. So we absolutely require that kind of interaction, because this is all about culture. I think Sean mentioned this. It's not just understanding the culture of the team leaders, it's the organization itself. That's very difficult to capture through this sort of communication vehicle, to get that depth, both them understanding who we are and what we're about, as well as who they are and what they're about. Because one of the big things is these people wake up every day and vote with their feet. Everybody that works for all these firms got called by 5 recruiters today. and they better be aligned to who you are, what you're about, so that when you acquire those companies, we're very proud. We've had 0 turnover from any acquisition we've done. And that comes back to making sure you get the right people, the right alignment of culture, and how you do business.
Thanks, Mike. Yeah, I think in terms of what has changed, there are some companies where we're seeing opportunities because they were hit by COVID for very specific reasons. If we believe the reasons are temporary and we see a path out, we'll take a look at it. I think on the other companies, what we've seen in the past 6 months, it's separated who was really interested in selling and who was out there fishing. So we saw some companies where the discussions have accelerated and others that have disappeared. We haven't seen a change in multiples. We don't typically compete with private equity for our deals because we look to keep the people. So whenever we know that the private equity is involved and the only issue is price, we typically walk away. And we have a few very easy qualification questions that we ask the people. And the first one, of course, is why are they selling? Which comes back to having that face-to-face meeting. So at some point, before we go too far, there will be that face-to-face, but we spend a lot of time on the qualification beforehand, so we don't waste too much time. So the why they're selling, are they interested in staying? And usually the killer question is the last one, and are they open to a cash and stock based transaction? And when they say they don't want any stock, typically we know it's because they do not want to stick around. So we usually walk. So despite all that, it's not for lack of targets out there. There's some very nice companies out there. I'd say the other advantage that we have is, and Mike can back me up on this, the Microsoft universe is not only pretty small, but it's very well known. So typically the Microsoft leaders go to the same shows, they go to the same award ceremonies, they interact with the same leaders in the Microsoft organization. So over time, these people know each other. We know the companies that are out there. We know the players. So same thing with Oracle, same thing with some of these other solutions. So you get to know these people over time, which accelerates the discussions because you know who you're dealing with the other side. Despite COVID, there are some personal relationships out there that we can leverage and get to find out more about these individuals. So we leverage that a lot. Being almost 2,300 people now gives us a lot of doors we can knock on.
And I'm going to reiterate what Paul just said. So the companies we acquire have been around for 25 years. We all hang out at the same vendor conferences. IBM made it really easy for me. They had an IBM software council. I took 5 members off the IBM software council, but we know all these people. So I met 84 of these companies. So you bring up a great point. When you can't meet them during COVID, I'm like, Mike, I wouldn't buy someone I hadn't met. But because I've met with 84 of them, so Unique Digital I bought in October the 1st, the owner, Andy Pratt, I talked to in November 2nd, 2017. So it took him a long time, but he's 73 years old. COVID scared him. He was like, oh my God, I just don't know what's going to happen. So he said, hey, you'll take good care of my people. We're going to sell to Converge. And I've told people, hey, when you're ready to become part of the family, come and join us. The other one is the tax changes that could be coming have driven a deal that we've been talking for 18 months will likely close in Q4 because they're scared of capital gains tax changes. So I think there's a bunch of different dynamics. Like Tim was mentioning, we can only pay on your results. So there was a company that we were going to acquire at the end of March that was heavily into the oil and gas sector that we said, hey, we can change that part to earnout. So here's kind of like the COVID piece that if you can regain that, we can pay you on that, but I can only pay you on your trailing 12. So we waited to see how they were impacted. A third of their customers were from oil and gas. I just couldn't, execute the amounts that we had done before. So we came back with a revised price, but turned some of that upfront payment into an earnout payment if they got back to that level. Now, we haven't closed that deal. So the companies that have been impacted, we haven't, they're in those sectors that we haven't been able to close those deals. But the acquisitions we're doing now, there's some tuck-in acquisitions that we're doing here in Q4. And then there's different motivations of how people psyche-wise that have been impacted by the pandemic.
Very good. And this one is also a COVID derived question. Given COVID, do you find that your end clients are playing defense, i.e. they're less likely to change their IT service relationships? And how does that impact you both from an ongoing operations perspective and in looking at acquisitions? Does the client list take on a greater value?
So if we're going to go reverse order here, I'll jump this one first, because what we saw is the companies that could respond to people during COVID. It was, you created some very special relationships. There were some companies that were deer in the headlights. They just didn't know what to do, work from home. They couldn't respond. They shut up shop. The companies that we buy, smaller companies that are nimble, the fact that we could so encompassingly help them, supply chain issues, we got a lot of customers through some really difficult times in the end of Q1 into Q2. And so that, I think, has really solidified those relationships where we're now, they know that when times are tough, they can rely on us. And I'm sure Paul and Mike would notice that as well, because there's some companies that you definitely notice have just weren't able to adapt. If they had not lean structures, not lean decision making, didn't have that customer service, they've been impacted. Customers aren't going back to those guys. So I think we've actually grown our wallet share because we were able to respond so well during a crisis that they know. I'm sure 08, 09 was the same thing. The companies that you could rely on during a crisis, of course, those are the teams that you want to be relying on.
Yeah, we because we did our own digital transformation a while back, and we were already set up to work in this new COVID environment. We set up an emergency, disaster site for our customers, and we were very proactive in sharing best practices with them, helping them set up. I remember our CIO had ordered several hundred laptops ahead of time because he saw this coming because of our operations in Europe. And we ended up having too many laptops, and we offered them to our customers because there was a huge shortage, if you remember, in the first month or so. I mean, they were flabbergasted that we even had access to these laptops. So we were very proactive. It was very well received, and we've seen, I think that's one of the reasons why we're seeing growth in our existing customer base, but we're also signing up new customers. We've signed several dozen new customers in the last 6 months. And these are ERP projects that a lot of people had pushed out and put on hold that are now saying, listen, this does work, even though people are remote, and we need these systems more than ever. To Mike's point earlier, and Sean mentioned it as well, the first thing that these companies need to do to be able to work remotely is their back office system, financial systems, accounting systems, HR systems, to be able to give their people secure access to that. So all these projects at the beginning that were on hold, we saw a huge effort to accelerate those projects, which is very positive for us.
Yeah, I'll echo the same comments. So the thing I would add to it is one of the things we are seeing is a changing behavior of how customers are choosing who they're going to partner with. Mm-hmm. To Sean's point a little bit, they had disruptions because some of their partner ecosystem that they maybe had working with them either couldn't adapt or had stress points and some of those things. The vetting process has shifted from, I'm going to select you to help me with this project, to I need to understand your full comprehensive capability, including your financial background and other kinds of things, to know that you're a long-term strategic partner, because this digital transformation thing is not an event that happens in a quarter. It's something I'm going to be doing over the next many years. And I need to choose a firm that has full complement of capabilities that can help you in that journey, as well as know and understand that you have the credentials and the background and the reference points to make that happen. So the vetting process has shifted in that way.
Great. Thanks for that. I've got a few questions that I received by email and on Zoom regarding talent. So I'll try to combine them into one. In one way or another, you guys all mentioned talent as being key, obviously. One, how does M&A help you guys tackle the challenges of talent shortage? Then two, maybe you could speak more broadly on the virtualization of the workforce and how it's impacting your hiring strategy in general. Have you seen an impact on the efficacy of working from home relative to being embedded on site? You guys feel being embedded on site is a thing of the past? So maybe you could all sort of touch on that. Thereafter, we'll also open it up for you guys to ask each other questions. So keep that in mind.
Yeah, so I'll go ahead and kind of reference certainly M&A. A big part of what we are looking for is how to capture some of the very specialized talent. There's many of these smaller firms have a few of these people locked up in it, and they maybe aren't using them for that capability because they don't have access to the project, so they have them go work on something else. So that's certainly an element, but certainly a global strategy. Part of what we've done is as part of our M&A is look for offshore capabilities to complement the onshore capabilities that we have across North America, which is an important component. There are certain types of engagements that customers rely on that sort of blended model approach, from a labor triage as well as the follow the sun strategy and things like that. The other thing, and we've been doing this for quite some time, is you can't rely on hiring highly skilled labor to do everything. You have to create a pyramid model that is scaling and growing and developing from within. So we've been doing college internship programs and college recruiting for several years, and continue to bring those folks in under a mentoring ambassador program that we have, and hiring folks on the backside of those internships. So it's a combination of those things that I think is critical in making sure that you are not just trying to poach people from somebody else, but that you're also developing talent from within.
It's an interesting question, because we don't acquire companies because we're short of people. Usually it's the other way around, that the companies we acquire are very high quality. Their challenge is actually finding people. So they don't have too many people sitting around doing nothing. They add capability, or they add the geographical presence, or a new sector that we go in. But what they like about our story is that we have a recruiting machine. So we actually have a very well-developed recruiting machine that's global, where we recruit all over the world. Some people work remotely, some people work in a certain geography. Today, everybody's working from home regardless, but still, the new reality has opened up some opportunities, because now we actually recruit some people where we tell them they're going to be working remotely day one. They'll never have to come in to work to the office unless there's something specific that we need them to address. But we're now recruiting people with these specifics of where they'll be based out of, and some of these people will be based from home. So it has opened up a new pool of talent. We also do a lot of internal development, college grads, retraining, our own leadership academy, and those and the likes. But to give you an idea, best in class companies, turnover rates around 10% globally. I mean, for a company like ours at 2,300 people, that means we have over 200 people year in, year out that we have to replace and support growth over and above that. So you need a significantly well-tuned and oiled recruiting machine, which we've put in place, which has been very efficient for us and very useful.
So a couple things I would add, especially around COVID. So before COVID happened, tech employment in the US was -4%, which means you had to steal someone from a job to get them there. COVID, though, released a lot of talented workers from hard-hit sectors. So these are really talented people that might have been working in oil and gas or in hospitality, et cetera. So the labor market definitely changed. Saying that, we do think that's transitional and that you'll get back to those things, even though the immigration laws that changes that were brought in the last administration, we believe will change in the next administration. So that will alleviate some of it. But the other one we've been using is nearshoring. So the innovation zones in Quebec, especially the cybersecurity zone in Gatineau, and the analytics one in Montreal. We've used those as nearshore because the analytics and cybersecurity resources in Silicon Valley, which is we're heavily involved in, are extremely expensive. New York are very expensive. So there's definitely a labor arbitrage. And we've got a great funnel there from the companies that are existing. We've got Becker Carroll in Gatineau, and we've got PCD in Montreal. The other big thing that we're kind of taking advantage of on these there is the practice area structure that we have. All the engineers are into these various practice areas. they have been very effective at being remote. But a lot of our skill sets were really concentrated in the Northeast. And so we view that kind of in mid-2021, it'll go back to a much more of an in-face model. So yes, definitely certain things will be much more remote than they ever were before, but there'll be more requirements for people to be on site. Therefore, we're doing tuck-in acquisitions in the central and western regions that we'll be announcing in Q4 that'll add skills around our analytics, our software, and hybrid IT skills that are in region, so that when we do go back to more of an in-face model, that we'll be able to address that more. Again, not to say that we won't, as much as possible, leverage our nearshore resources in Quebec, but that we will also have those critical resources, the solution architects in particular, that will be on site.
Great. So we just want to close it off at 1:30, so we probably have like time for one question. So Mike, Paul, or Sean, or even Tim, do you guys want to pose a question to close it off? Putting you on the spot there.
So I'll throw one out there. So the different models. So again, by segment though. So for me, like Paul, who's into and it goes, Paul, you're half Canada, half the rest of the world. Does the segment of large enterprise, how is that impacting you of being in face versus remote on ERP migration projects versus some of the other ones? Because I would have thought that you would have had to be much more in person in that segment, the large enterprise segment.
9 months ago, whether we could deliver ERP systems remotely without ever going to the customer site, I would have said you're out of your mind. Necessity is the mother of all invention. So we had to adapt. We had customers who wanted these systems to go in. They needed these systems to go in. It was a matter of survival. And we adapted. It was interesting on the Microsoft side, their last Microsoft conference, which usually brings everybody together, they had to do virtual. And they asked the lead of our practice to explain how we implement these ERP systems remotely without ever going to the customer site. And I tell you, it's introduced a lot of discipline. Before, because the people were there, it was very simple to grab somebody by the arm and say, hey, fix this or do that. But being remote introduces a lot of discipline, a lot more focus. And to be honest, these implementations are actually going better remotely than when we're on site. Now, from a customer relationship perspective, because we also do a lot of follow-up works and upgrades and so on, you need that contact. So we will eventually get back to having these on-site visits. But I tell you, I think this really has changed the way we approach these projects forever.
Very good.
Thank you.
Now, Paul, since you took a
question.
Oh, go ahead. Go ahead, please.
Rob, if I could ask one last question. This is a one-word answer, yes or no, from each of the other three panelists. COVID or no COVID, would you be interested in acquiring all virtual companies versus those that have some brick and mortar?
No, for me.
All virtual companies today in a heartbeat.
Paul, yes. Sean,
yes.
no.
I'm
Yes,
a no. Yep.
Cool. And then just to offer the opportunity, Paul, you took a question. Do you want to give a question?
I'd be interested in Tim's perspective on, this whole remote real estate situation. What do you see long term? Do you see people coming back to what they were before, or is this going to be a new normal?
Yeah, I think what we're seeing across the board from a lot of would-be sellers and such is that they're adapting to the COVID city concept, where they're allowing their employees to move into Butte, Montana, and other wonderful places to live and still be involved in their business. But my belief is that propinquity counts. Proximity and brick and mortar and being in teams, physical rooms, and I think we'll never lose that. But for those employees that have maybe a desire to dot in and out and be in another location, I think that genie is out of the bottle at this point. And in order to retain some of this great talent, businesses are going to have to need to be flexible.
Mike, we'll give you a question to throw out. We'll give you the opportunity, to throw out a question.
Yeah, and open this up to Tim or anyone. As you think about 2021, And kind of as we've got all these factors of in the U.S. in particular with the election tax consequences as well. I know that we think there's going to be a lot of movement. Do you anticipate anything happening in terms of valuation changes, deal structure changes, and things like that as we progress through the year?
I could jump in. At least the tea leaves that we're seeing right now, and I agree with, I think a few other panelists had mentioned this, is that we haven't seen any major material shifts in valuations of multiples, whether it be some of the high flyers, MSSPs that are multiples of revenue, or the rest of the world that are still playing with mostly multiples of adjusted EBITDA. But I do think that the trend of having a little bit less cash up front is going to maintain itself at least through, we're looking at least another 12 months or more before COVID starts to tame down a little bit. And that's what we're seeing.
Thanks.
Thank you. Anyone else care to join in?
No, that's great. And just to keep us on time, that was
Awesome,
a fantastic
Simon.
discussion. Good afternoon, everyone. My name is Simon, and I head up the institutional sales and trading effort here at Echelon. A great discussion today. I first wanted to say thank you to our guest speaker, Tim Mueller, CEO of IT ExchangeNet. Very informative session on the current trends in IT, very revealing, especially since COVID has been one of the largest disruptors for the sector in years. Tim's knowledge in the global IT marketplace has helped many IT startups find investors. So thank you, Tim. And also thank you to Sean from Converge, Mike from Quisitive, and Paul from Alithya for sharing their corporate stories. Each one has a very compelling investment proposition. In my view, Converge is considered a hybrid IT provider with a clear track record of M&A integrations with cost reduction and synergies that have driven increased corporate valuations. Quisitive, one of the fastest growing and most recognized Microsoft cloud innovation providers with a record of M&A for increased growth opportunities. And last but not least, Alithya, providing full service IT across platforms, including AWS, Microsoft, and Oracle, with best-in-class service for clients and strong organic growth for investors. So thank you. And also a big thanks to Rob and Amr. You put together a great conference for our Echelon clients, highlighting a sector that is experiencing explosive growth, synergistic opportunities, and outpaced performance for investors. Echelon Capital Markets this year in 2020, we've innovated quite a bit in the marketplace with the new full-service debt financing platform, while focusing our originations and M&A advisory services to cater to all the mid-market companies in North America. Been a big leader in the financial services among the independents. We've been embracing digital transformation, outreach, and opportunities such as our signature virtual conference series for healthcare, for cannabis, mining, and technology, which you can find on our YouTube channel. Our webcast series called Valuable Insight Expert Opinions are interviews with experts across financial services, highlighting our commitment to best-in-class information for all of our clients. And lastly, thank you to the participants for attending. We'll be providing videos of the conference on YouTube in the coming days. So if you missed something, feel free to check in with our channel. Have a safe and happy holidays. Thank you for attending. Good afternoon, everyone.